Hey everyone, welcome back to Corporate Decoder, the place where we dig into the documents companies don't want you to read. Today, we are diving into something that involves a lot of numbers and some potential future changes. Don't worry, we'll make it interesting. We're looking at Synchrony Financial, the company behind a ton of store credit cards. They just filed a Form 8K, a current report filed after a big event. The gist is they're borrowing a lot of money. Let's see why and what it means. Synchrony Financial just put out an 8K filing. This is basically a company shouting, hey, something important just happened. It's way more immediate than their regular quarterly or annual reports. Think of it as a corporate breaking news alert. Today, Synchrony is raising a good chunk of cash. Synchrony Financial is the real name behind many store-branded credit cards. Think about that card in your wallet for a specific clothing store or electronics retailer. Chances are Synchrony's the one actually handling the credit behind the scenes. They are pretty big when it comes to that sort of business. Okay, so the key date here is March 6, 2025. This is when the big event they're reporting on happened. In this case, it's tied to when the paperwork for this borrowing was finalized. Here's the headline: Synchrony is issuing $800 million. That's $800 million in new notes. These are basically IOUs, promises to pay back the money they're borrowing with interest. The interest rate starts at 5.450%. That's 5.450%. These are called fixed to floating notes, meaning the interest rate will stay the same for a while, then it will change based on market conditions. This whole thing is connected to a registration statement they already filed. Think of it as them getting permission from the Securities and Exchange Commission, the SEC, to offer these notes to the public. It is like getting a permit to sell something. There is something called an indenture. It is like a rule book for these notes. It's between Synchrony and the Bank of New York Mellon, which acts as a trustee, a protector of the investor's interests in this case. So the indenture lays out all the specific details about these notes, how they work, and what happens if Synchrony can't pay. If you are interested in reading all the details, you can find the agreement they made with the banks in Exhibit 1.1 of this report. It's worth looking at if you want to know all the specifics. There's also a legal opinion from Sidley Austin LLP, a law firm. It basically says these notes are legally valid. It's a standard part of these kinds of deals. Lawyers need to say things are being done right. We're at the exhibits section. This is where the actual documents related to the deal are filed. It's like the appendix of a book where all the supporting information lives. Here we see the agreement between Synchrony and the banks that are helping them sell these notes. These banks are called underwriters. It lists out all the details of the deal. This is the 13th supplemental indenture. It is an addition to the original indenture that sets the rules for these kinds of notes. This is the actual document that describes the notes themselves. If you were going to buy one, this is what you'd want to look at. And this is Sidley Austin LLP, the law firm we talked about before, giving their official okay that everything's above board. So what's the big picture here? Synchrony is borrowing $800 million. That's a lot of money. Why are they doing it? Well, companies borrow money for all sorts of reasons. Maybe they want to invest in new technology, expand their business, or simply refinance existing debt. Without more information, it's hard to say exactly why they're doing it. But the fact that they're issuing fixed to floating rate notes could mean they expect interest rates to potentially decrease in the future. Otherwise, they would just lock them in at a fixed rate. This is a pretty common move for financial companies. They borrow money to make more money, that is, to lend it to customers and collect interest on that. Synchrony is in the business of consumer credit, so it makes sense that they would need a lot of capital. Now, let's step back and look at Synchrony as a whole. They are a pretty big player in the store credit card market. This market can be a bit risky because it's tied to consumer spending. If people stop shopping, they stop using their credit cards and Synchrony's profits go down. On the other hand, Synchrony has some advantages. They have partnerships with a lot of major retailers, which gives them a steady stream of customers. And they've been investing in technology to improve their customer service and fraud detection. Overall, Synchrony seems to be in a decent position. They're not without risks, but they're a well-established company with a solid business model. This borrowing of $800 million is a significant move, but it's not necessarily a sign of trouble. It's just part of doing business in the financial world. So what does all this mean for you? Well, unless you're a Synchrony shareholder or a bond investor, it might not have a direct impact. But it's a reminder that the financial world is complex and interconnected. Companies are constantly borrowing and lending money, and it all has an impact on the economy. Thanks for watching. If you found this helpful, please hit the like button, leave a comment, and subscribe for more corporate decoding. Until next time,